Hey everybody, Tom Berry here with ILS Legacy Holdings, and I've got a quick market update for you on the real estate market. I wanted to share with you an article that I just read this morning. I read articles from a lot of different sources every day. It's just part of what I have to do in order to try to stay on top of what's going on in the real estate market in particular and in the economy more generally. So the article had a headline that said Austin rents nosedive 12.5% in December. Now, I don't usually read a lot into a headline because oftentimes when you get into the meat of the article, it isn't not talking about anything about what you thought it was based on the headline. Most of it is what they call clickbait. But as I read into this one, it was very fascinating. So, in Austin, Texas, and I will paraphrase the article, go look it up if you'd like to see the whole thing, but in Austin, Texas, rents in apartments did nosedive, and I think nosedive is an accurate assessment, 12.5% year over year in December 2023. That is a fascinating headline. It was the second largest decline of all U.S. major markets. The only major market that declined worse than Austin was Salt Lake City. So in Austin, it fell from $2,270 a month in average rents for an apartment to $1,985 per month for the average apartment. Now in Salt Lake City, it fell 21% year over year in December. Again, just incredibly bad numbers if you're an apartment investor in either one of those two markets. Austin occupancy is the worst occupancy of anywhere in the Sunbelt USA at 86% as of January. So what does this mean for you, an active investor or a passive investor that's investing in syndications and so forth? I think the first thing that we need to realize and understand is rents can fall. Now, that sounds obvious, right? Everything that goes up can go down. But it's not obvious in the investor community. And I know this from all the traveling around the country that I do and all the real estate investors that I talk to, whether actively purchasing or passively investing in those syndications and funds. A lot of the people that I talk to don't believe rents can fall. And a lot of deals that have been done over the last 4 to 5 years, particularly in the apartment sector, have been done based on rents never falling. Now, what do I mean by that? I read PPMs, private placement memorandums, all the time, and I talk to active syndicators and sponsors and fund managers all the time. And right now there are a lot of deals that are being done today and have been done over the last couple of years where these purchases are being made at 5 cap, 5.5% cap rates, 6%, and 6 is considered a good deal today. Those numbers may have worked when we had really cheap interest rates, but they only worked with two things in mind. They worked with cheap rates and rising rents. If rents stagnate, those deals no longer work, and they really no longer work if you can't have those cheap rates to fuel them and fund them. So I think the big issue that I see in this article is we now have proof of something that a lot of people in the investing community have not been acknowledging for years and years, and that is that rental rates can fall. And this is particular to Austin and Salt Lake City, and it is particular to apartments. But I can tell you with certainty, and I can tell you from experience, it can happen in any asset class and in any market. I'll remember 2008 and 9 when I had a portfolio of single-family homes in Galveston County, Texas, that I had to lower the rents on substantially just to keep them full. And that in an environment where a lot of people were losing their homes and losing home ownership and had to move into rentals. But we still had a glut of rentals and we had to lower rates. Now, of course, in the article, it talked about the causes for Austin and Salt Lake City's decline in rents. And as you might have expected, it goes back to Econ 101, supply and demand, overbuilding of apartments in those two markets. But I can tell you, it's going to happen in other markets around the country. So if you're a purchaser of these things, or you're an investor in a syndication or fund that's buying them, make sure that you're buying them on numbers that can sustain a reduction in rents. Most of those deals are being done with the promise of raising rents. And when you look at raising rents a certain percentage or declining rents of 12.5% in Austin's case, there's a substantial difference in profitability, and it could take you from profitability to a capital call or loss. So hopefully that's helpful for you, and I'll keep sending these videos out as I see more interesting articles that I want to share. Here at ILS Legacy Holdings, we are dedicated and committed to helping you plan your path to wealth as an active or passive real estate investor. Visit ilslegacy.com to see how our companies bring investors together to help meet their financial goals.